Hey guys, TommyBryson here, and today we're going to talk about exactly what do you do when the stock market crashes, and is there going to be a crash pretty soon? And by the way, my investments right now are up 18%, which they are not supposed to be up this high. But I will break it down by the end of this video and why I'm actually making so much money right now and how you can do the same when the time actually comes. By the way, if you're new here, I post videos every single day, so make sure to also subscribe and hit the bell so you're notified. And on top of that, also destroy, dismantle, just hit the like button. I really appreciate it. Thank you guys so much. And now, the first thing I want to make very clear here is that basically it is impossible to predict exactly what the market is going to do and also when the market is actually going to crash. Although there are signs to show you like, hey, maybe it might crash, maybe it's way too high, maybe it's way too low, maybe we're due for a correction sometime soon. There are always signs out there, but for someone to tell you, hey, today at 3 p.m. the market is going to crash. In reality, most of the time that's BS. Warren Buffett says it. Every single financial person that actually does investing for a living, in reality, will tell you it's impossible to go ahead and predict the market. Although you can see the signs. But if we can't predict the market, then what can we do when the stock market actually crashes? And there's only one thing you can do, and that's called take action. And that's what I did, for example, back in March when it crashed, and I bought a ton of investments, which I will tell you about in this video also. But the first thing you need to know is this, guys. You need to do these two things before and after the market is actually crashing and actually during, okay? And the answer is you need to be, for example, investing while it hasn't even crashed yet. And on top of that, you need to have a reserve of money for when the market actually crashes. For example, okay, the average person, when it comes to investing, they're very excited when the market is going up and it keeps climbing and climbing and climbing, and they keep dumping in more and more and more money. But in reality, they might just be buying at peak prices. However, on the other hand, whenever the market actually crashes and we're due for a correction and it actually happens, well, in reality, that same person becomes panicked, stops investing, and in some cases might even sell other investments for a massive discount. So what we want to be during a panic, in a sense, right? We want to be the opposite, and we want to be the person actually buying a lot more in stocks in our investments, because we know basically we are getting those investments at a massive discount because everyone else is selling, which makes the price lower, which makes us be able to actually go ahead and buy the same investments for a much lower price. And that's the entire goal when it comes to how do you think whenever it comes to like, hey, the market is down, the market is up, okay? Warren Buffett says, for example, you want to be fearful when everyone is optimistic, and you want to be optimistic when everybody is actually fearful. So it's kind of like being like the opposite when it comes to the stock market. Like, hey, yeah, everyone's buying, buy, buy, buy. Well, you want to be careful there. But when everybody's selling, 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 that's when you might want to be buying and looking for opportunities, because basically everything is going to be at a discount. And by the way, the average market correction only lasts between like 4 to 6 months. So in reality, if you're selling and then 4 months it recovers, then you just lost a ton of money. Okay, so just hold on. Most of the time, that's the best strategy. But here's exactly my strategy, and here's exactly what I do, guys, okay? Before the market actually crashes, what I'm doing is always called dollar cost average, meaning that every single week I'm investing X amount of money. Usually, you know, it used to be like around $125. Right now, I'm doing a lot more money. But for example, the average used to be around $125 I'm investing every single week, right? So the idea is by doing this, over a long period of time, I'm basically guaranteeing I'm going to be buying at a high price, yes, but also at a low price. So in reality, it averages out. So by doing dollar cost average, buying the same investments over a long period of time, consistently at the same time, every single week or every single month, you're going to guarantee yourself the average return over a long period of time. But again, it only works if you're buying during the good times and also during the bad times. Now, while I'm doing this consistently, I'm also stockpiling some cash on the side in case the market crashes and it's time for me to take action and start to dump even more money into my investments. Now, as you guys may know, the app I use to invest is called Acorns, okay? And with Acorns, I have a portfolio that's 80% stock ETFs and also 20% bonds. And by the way, my Acorns portfolio right now is at around $31,500, but I'm also up around 18%. And on top of that, when I started out with $7.60 back in December of 2018. And today it is 2020. August, okay? So 2 years later, I have a lot more money invested. I'm also up around 18%. So the idea is that by doing, for example, my normal investment strategy, but also stop on some cash, I was able to capitalize when the stock market actually crashed. Now, let me explain here, okay, guys? So for example, guys, okay, back in March, when the pandemic actually happened and everyone was scared and everyone's actually selling and panicking, that's when I chose to grab the money I had on the side, which at the time was around like $20,000. I grabbed that money and I actually invested it at the lowest point in the market. Now, I did it in a way to basically guarantee I was going to catch the lowest point when it came to the entire like lowest point back in March, okay? And the idea is, instead of investing the 20K all at once, I split it into 2 payments of 10,000 and 10,000. That way I bought 1 week at a very low price of around like -10%, and then I bought the next week at around -15 to -20% in a sense, okay? And that's exactly what I did. And that way, by splitting it up like that, I'm almost guaranteeing that, hey, if it goes lower, don't worry, I'm going to buy at a lower point also. So whenever you have, for example, a large amount of money, maybe like $1,000 or $10,000 or $100,000 and you want to invest, the answer is try splitting it up maybe like in 1 month or 2 months of investing, and that way you can get the average price or the average lowest price during that time period also. But I never stopped investing my 125 weekly, like around like $500 every single month. That way I kept doing my entire dollar average strategy, but I did capitalize when the market actually did crash. And that's the entire idea when it comes to a strategy. So overall, what you want to do is you do dollar cost average. You invest the same amount of money every single week or every single month, the same amount of money, the same amount of time, consistently over a long period of time to guarantee you the average return, for example, during the good times and the bad times. But while you're doing that, you also save up around like 10 to 20% of your money in cash. And that way, when the time comes, you go ahead and you invest and you invest and you invest and you buy at a discount. Now, you might say, Tommy, that's a dumb idea because basically your money is losing value, inflation, this. But if you ask me, notice this, okay? You also have, for example, Warren Buffett with billions of dollars in cash. And why do you think he has that money? Because in reality, there's nothing out there that's cheap enough for him to actually buy it at a discount. So he's waiting also. So the point is, if you want to have that money somewhere, well, you might want to put it, for example, in a high yield savings account. It's not going to pay you that much money in reality, but at least it's going to slow down inflation in a sense, okay? That's the core idea there. Or you might want to put it in a bond or something like that, short term, but then you have the problem like, hey, what happens if the crash only lasts, for example, a month? I have to sell it, then get the money, then send the money over to my account. It might take 3 days, and by that point, it might be over. So I'd rather just keep it in a high yield savings, send the money ASAP over, and then buy my investments right then and there. And that way I don't waste any time. However, okay, number 3 here in the last part of this video, guys, okay? What happens if, for example, you don't have a lot of money to actually invest when the time comes? So, for example, you don't have any money to actually put aside every single week when you actually get paid 10 to 20% for your cash reserve, okay? The answer is what you want to do is this, okay? Say, for example, you're investing into my portfolio, which is called Moderately Aggressive, and it's on Acorns, and I also have a link down below for M1 Finance if you want to copy my portfolio exactly how it is, okay? The idea is if you do something called rebalancing your portfolio, you can achieve the same exact results. And here's how, okay? Say, for example, right now, my portfolio is set up around 80% stock ETFs and 20% bonds. That's the ratio I want to keep because that's my risk tolerance, okay? So the idea is that, for example, during good times in the market, my stocks are going to outperform my bonds. During bad times in the market, my bonds are going to outperform my stock ETFs. That's normal. That's how economics works, right? However, when I actually have that actually going on during the bad times, guess what? My bonds go up, right? But my ratio is also going to be flimsy. I might go from 20% on bonds to maybe 25% bonds or 30% bonds, right? Because basically the value of the bonds tend to go up while the stocks value tend to also go down, right? So the ratio of 80-20 is going to be all screwed up. So the answer is during these time periods, I might want to, for example, sell some bonds and buy some stocks for cheap, stock ETFs for cheap, and that way I can return to 80-20, but that way I get to sell my bonds really high and buy my stock ETFs very, very low. So that way you use the money you have to balance everything out, okay? Now, I would do this around every 12 to 18 months normally to achieve the ratio you actually want for your risk tolerance. That's what I currently do. However, if you have Acorns or M1 Finance, these apps right there do the process for you automatically. Acorns does it automatically, but with M1 Finance, every time you invest, and make sure to keep that exact same ratio. So for example, say for example, you're in a bad year and your stocks are maybe like 70% and then your bonds are 30%. So all the money you put into M1 Finance, if your ratio is 80-20, they're going to put it most towards your stock ETFs to return it back to its normal value. And that way you buy a lot more cheaper stock ETFs than you go ahead and buy bonds. And that way you don't even have to rebalance and sell anything and assume any taxes. So that's also a pretty good way to invest. So I'll put my links down below for Acorns and also M1 Finance, my portfolio. That way you can sign up. I think with Acorns you get $5 and with M1 Finance you get $10. But everything is automated in a sense, so don't even worry about it. But that's the core idea here. So guys, overall in this video, if you're wondering, Tommy, but I don't know how to predict the market. In reality, you don't have to. Just keep investing. Do not be that person that waits until the market crashes and doesn't invest whatsoever, because in reality, the time is never going to come. You don't know when it's going to come actually, and you might just miss it, okay? So the answer is just keep investing, keep investing, keep investing. When the time comes, have some cash inside and dip it in instantly, and that way you get the lowest price at the right moment, right then and there. That's the idea. And by the way, this tactic right here can also be used in the real estate market. For example, you're buying your properties, but you're also saving up money inside. And that way, if the real estate market crashes, you can always go ahead and buy some properties for a massive discount also. That's the strategy I use. Comment down below and let me know, guys. Was this video helpful? Are you going to use it? And right now, what is your goal for the end of the year 2020 when it comes to investing, or 2021 whenever you're actually watching this video? Comment down below, let me know. I'll see you guys tomorrow. Thanks for watching. As always, make sure to also like this video. On top of that, also subscribe to the channel and hit the bell so you're notified. And if you want to talk to me one-on-one or text me, just subscribe to my Patreon, link down below. Or for example, just DM me on Instagram, TommyBryson. And before I go, if you want to see exactly how much money I get paid in dividends, watch this video right here. And click my Patreon. I'll see you guys tomorrow. Thanks for watching. And as always, peace.